let's say I have my mobile practice or brick and mortar practice, and I have a policy like this, and you know what? I just the practice has exploded. It's going great. I'm making $1 million a year in my practice, and I decide, you know what? I'm gonna cash it in and start my fishing trips early in life, and I'm gonna sell it when I'm 55. And so now essentially I'm retired, but I have all this money that I've put into disability.
Yeah.
So I'm not really working anymore. Does it still, do I still have to have some sort of a qualifying event to be able to access that money, or what happens there?
Yeah, great question. So depending on when and how you ended up disabled, as far as so I'm gonna answer a few different, because I heard the same question a few different ways.
Yeah.
Interpret it. So one way I interpret it is, if I've put all this money into this policy, is it a spent cost? Is it just an expense, or is there an asset component to it? By and large, long-term disability is very similar to term life insurance and health insurance, and in that it's a cost. And if you need to use it, awesome that you had it. Sorry for your luck that you needed it. On the other end of it, if you never used it, it's just an expense, and that's kind of what keeps those companies going. So as far as being able to access funds that were put into it, think of it more as an expense, which, speaking of, just an aside, and not that this is direct tax advice, but there are certain expenses that you want to write off in your business and certain ones that you don't. You don't want to write off the insurance premiums for long-term disability, because if you do, and you get disabled, you now pay taxes on the disability income. If you write those off, if you want to take that gamble, then you just have to know that the proceeds from the disability policy in an event would then be taxable. I typically don't think it's usually you have so much other stuff that you can write off in your business that writing off your disability premiums don't make a lot of sense. The exception to that would be if let's say that you've got a number of employees, and you got group disability for everybody, just to make sure you're protecting a little bit of their income. That's when that you could write off. And then you let the employee worry about the taxes. It's kind of a give and take, right? You provide the benefit, they pay the taxes. But going back to what you're saying, in that event that you sell off the practice, I would say that's where you're evaluating with your advisor or yourself or your account, however you choose to manage and evaluate money in your position in life. I would say that would be the determinant of whether or not to carry certain insurances. Now, because it's protecting the income, as far as whether or not you could keep it, a lot of people in that situation where they're financially independent just let the policy expire. You just cancel the policy. Some people, though, even though they're checked out, they're still doing something on the side. You might be able to recharacterize that policy to cover that if you choose to keep it.